Hello traders, in today's video we are going to talk about 5 most powerful candlestick patterns, the hammer, the bullish engulfing, bearish engulfing, morning star and evening star candlestick patterns. Let's start with hammer candlestick pattern. Hammer is a bullish reversal pattern that forms at the bottom of a downtrend, signaling a potential trend reversal to the upside. The hammer has a long lower shadow and a small real body, typically red or black. The long lower shadow represents the rejection of low prices and the small real body represents the buying pressure overcoming the selling pressure. This pattern shows that the bulls are taking control of the market and are likely to push prices higher. To confirm the hammer pattern, traders should look for a bullish confirmation candle, such as a white or green candle, that opens above the hammer's real body. This confirms that the buying pressure has continued and traders can enter a long position. However, it's important to note that not all hammers are created equal. The best hammers have long lower shadows, small real bodies, and occur after a long downtrend. Traders should also pay attention to the volume during the formation of the hammer, as high volume can indicate stronger buying pressure. The hammer is a powerful bullish reversal pattern that traders can use to identify potential trend reversals and enter long positions. Make sure to watch out for a confirmation candle and look for the best hammer formations with long lower shadows and small real bodies. I hope this helps. Let me know if you have any other questions. Let's explore bullish engulfing candlestick pattern. In the world of trading, it's important to be able to identify patterns that can help you make more informed decisions. One such pattern is the bullish engulfing candlestick pattern. The bullish engulfing pattern is a two-candlestick pattern that occurs at the end of a downtrend. The first candlestick is a bearish candle, followed by a larger bullish candle that engulfs the bearish candle. The bullish engulfing pattern is a strong indication that the trend is about to reverse. It signals a shift in momentum from bearish to bullish and can be a powerful tool in identifying potential buying opportunities. Traders can use the bullish engulfing pattern in conjunction with other indicators to confirm their trades and increase their chances of success. Remember, the bullish engulfing pattern is just one of many tools in a trader's arsenal, but it can be a highly effective one if used correctly. So, keep an eye out for this pattern and use it to your advantage. Before we discuss about bearish engulfing pattern, please hit the like button and subscribe our channel. Thanks. Let's start discussing bearish engulfing pattern. The bearish engulfing pattern is a popular candlestick pattern used in Forex trading to signal a potential reversal in the market. This pattern is formed when a small bullish candle is followed by a large bearish candle that completely engulfs the previous candle, indicating a shift in market sentiment from bullish to bearish. The bearish engulfing pattern is a strong indicator of a potential downtrend in the market. It is often used by traders to enter a short position, with a stop loss above the high of the bullish candle. However, it is important to note that the bearish engulfing pattern should always be confirmed with other technical indicators and analysis before making a trading decision. Traders should also pay attention to the volume of the bearish candle, as higher volume indicates stronger bearish pressure and higher probability of a trend reversal. In conclusion, the bearish engulfing pattern is a powerful candlestick pattern that can signal a potential reversal in the market. However, traders should always confirm the pattern with other technical indicators and analysis before making a trading decision. You should join our Telegram channel for free signals and analysis. Let's talk about morning star candlestick pattern. Morning star candlestick pattern, one of the most reliable bullish reversal patterns in technical analysis. The morning star pattern is made up of 3 candles. The first candle is a long bearish candle, the second candle is a small candle that can be bullish or bearish and gaps down from the previous day's close, and the third candle is a long bullish candle that closes above the midpoint of the first candle. This pattern shows that the bears were in control during the first day, but the bulls took over on the second and third days, leading to a possible trend reversal. The smaller candle in the middle represents a period of indecision in the market, but once the bulls take over, they push the price up significantly. Traders can use the morning star pattern to identify potential buying opportunities and can also use other indicators such as volume and trend lines to confirm the reversal. However, It's important to note that not all morning star patterns are created equal. It's essential to look for additional confirmation before entering a trade and to manage your risk effectively. This is our responsibility to provide you more accurate information on Forex trading so you may earn a good profit. Let's talk about Evening Star Candlestick Pattern. This is a popular candlestick pattern among traders that can provide insight into potential trend reversals. An evening star pattern is a three-candle pattern that appears at the end of an uptrend, signaling a potential reversal. The first candle is a bullish candle, followed by a small-bodied candle, and then a bearish candle. The bearish candle should close below the midpoint of the first bullish candle. The evening star pattern is a strong signal that bears are taking control of the market. The small-bodied candle in the middle indicates indecision, and the following bearish candle confirms the reversal. Traders typically look for confirmation of the pattern, such as a break below a trend line or support level, before entering a short trade. Let's look at an example of an evening star pattern. On the chart, we can see an uptrend with a long bullish candle. The second candle is a small-bodied doji, indicating indecision. The third candle is a bearish candle that closes below the midpoint of the first candle. This confirms the evening star pattern and suggests a potential reversal in the trend. The evening star pattern is a powerful reversal pattern that traders can use to identify potential trend changes. It's important to wait for confirmation before entering a trade, such as a break below a support level. Remember to always use proper risk management and follow your trading plan. That's it for today's video. We hope you found this guide helpful in your trading journey. Don't forget to like and subscribe for more trading tips and strategies, and we will see you in the next video. Telegram channel link in description. The bullish Harami occurs after a downtrend and is characterized by a large bearish candlestick followed by a small bullish candlestick. The bearish Harami occurs after an uptrend and is characterized by a large bullish candlestick followed by a small bearish candlestick. To confirm the Harami pattern, traders should wait for a third candlestick to close above the high or below the low of the Harami candle. This third candlestick confirms the trend reversal, and traders can use this as an entry point for their trades. To enter trade, enter a short or long position at the end of confirmation candle. Don't forget to subscribe my channel for more price action videos. The piercing line is a bullish to candlestick pattern that occurs after a downtrend. It's characterized by a large bearish candlestick followed by a large bullish candlestick that closes above the midpoint of the first candlestick. The pattern signals a potential trend reversal, as the second candlestick shows that buyers have entered the market and are pushing prices up. Traders can use the piercing line pattern to identify potential buying opportunities. They can enter a long position when the third candlestick closes above the high of the second candlestick. Stop-loss orders can be placed below the low of the first candlestick to manage risk. The Dragonfly Doji is a popular candlestick pattern used by technical analysts to identify potential trend reversals. It is formed when the opening and closing price are at or near the high of the trading session, with a long lower shadow and no upper shadow. This creates a shape resembling a dragonfly, hence the name. The Dragonfly Doji indicates that sellers dominated the market early in the trading session, pushing prices lower, but buyers then stepped in and drove prices back up to close near the session high. This shows a shift in momentum from bearish to bullish and can suggest that a reversal in trend is imminent. The three black crows is a bearish candlestick pattern that consists of three consecutive long black or red candlesticks with low closing prices. This pattern is a strong signal that a bearish trend is forming, and it's often seen as a reliable indicator of a trend reversal. The pattern suggests that the bears are in control of the market, and they are pushing prices lower. The three long black candlesticks indicate that selling pressure is increasing, and buyers are losing control. Traders can use the three black crows pattern to identify potential selling opportunities. They can enter a short position when the fourth candlestick opens below the low of the third candlestick. Stop-loss orders can be placed above the high of the third candlestick to manage risk. The three white soldiers is a bullish candlestick pattern that consists of three consecutive long white candlesticks with higher closing prices. This pattern is a strong signal that a bullish trend is forming, and it's often seen as a reliable indicator of a trend reversal. The pattern suggests that the bulls are in control of the market and they are pushing prices higher. The three long white candlesticks indicate that buying pressure is increasing and sellers are losing control. Traders can use the three white soldiers pattern to identify potential buying opportunities. They can enter a long position when the fourth candlestick opens above the high of the third candlestick. Stop-loss orders can be placed below the low of the third candlestick to manage risk. The bullish belt-hold line pattern is a bullish candlestick pattern that occurs in a downtrend. It is characterized by a long white candlestick that opens at or near the low of the day and closes near the high of the day, without any shadow or wick on the lower end. This pattern signifies a bullish reversal and suggests that buyers have taken control of the market from the sellers. Traders can use the bullish belt-hold line pattern to identify potential buying opportunities in a downtrend. They can enter a long position when the next candlestick opens above the high of the belt-hold line candlestick. Stop-loss orders can be placed below the low of the belt-hold line candlestick to manage risk. Don't forget to subscribe and join our Telegram channel for latest news and analysis. When a stock is in a strong downtrend, it can be challenging to find opportunities to buy. However, there is a bullish candlestick pattern that traders can look out for when prices are reaching their nearest support zone called the Morning Star pattern. The Morning Star pattern consists of three candles. The first candle is a long bearish candle that represents the current downtrend. The second candle is a small-bodied candle, which indicates indecision in the market. The third candle is a long bullish candle, which signifies a potential reversal in the trend. The Gravestone Doji is a candlestick pattern that is formed when the opening and closing prices are at the low of the day, with a long upper shadow and no lower shadow. It gets its name from its shape, which resembles a gravestone. The pattern indicates that the market opened near its high and then sold off during the day, closing near its low. It is considered a bearish pattern and can be a sign that the price may reverse and start to trend downwards. When trading the Gravestone Doji, traders may consider taking a short position below the low of the Gravestone Doji, with a stop loss above the high of the pattern. Don't forget to subscribe my channel. The Marubozu candlestick pattern is a popular candlestick formation used in technical analysis. It occurs when the opening price of an asset is the same as its low price and the closing price is the same as its high price, resulting in a candle with no upper or lower shadow. This pattern indicates a strong trend in the market, as the absence of shadows implies that the price movement was unidirectional throughout the trading period. A bullish Marubozu occurs when the closing price is significantly higher than the opening price, while a bearish Marubozu occurs when the closing price is significantly lower than the opening price. Confirmation of the Marubozu pattern is crucial before taking a trade. Traders typically look for a second candle to confirm the pattern, which should show further price movement in the direction of the Marubozu candle. The entry point for the trade should be taken at the start of the next candle following the confirmation candle. The inverted hammer is a bullish reversal pattern that occurs at the end of a downtrend. It has a small real body near the bottom of the candlestick, with a long upper wick. This pattern indicates that the bears were initially in control, but the bull stepped in to push the price up to close near the high of the day, signaling a potential reversal in market sentiment. The hanging man, on the other hand, is a bearish reversal pattern that occurs at the end of an uptrend. It has a small real body near the top of the candlestick, with a long lower shadow. This pattern indicates that the bulls were initially in control, but the bears stepped in to push the price down to close near the low of the day, signaling a potential reversal in market sentiment. To enter trade, wait for confirmation candle. Rising 3 method is a bullish continuation pattern that occurs after a strong uptrend. The pattern consists of 3 short-bodied candlesticks followed by a long-bodied candlestick, with the first 3 candlesticks being contained within the range of the previous long-bodied candle. The long-bodied candlestick that follows represents the resumption of the uptrend. Traders often look for confirmation of the pattern by waiting for a bullish candlestick to close above the high of the last candle in the pattern. This provides an entry signal with a stop loss placed below the low of the pattern. Profit targets can be set at prior resistance levels or using a trailing stop to ride the uptrend. Don't forget to like this video, subscribe for more price action videos. Falling three methods is a bearish continuation pattern that occurs during a downtrend. It is formed by a long red candlestick followed by three small bullish candlesticks, and then a long red candlestick again. The three small bullish candlesticks should be contained within the range of the first long red candlestick. This indicates that buyers are not strong enough to break the trend and are only making a temporary pause. The pattern is confirmed when the final long red candlestick breaks the low of the previous candlesticks. Traders often look for this pattern as a signal to sell since it indicates that buyers are still in control of the market. It is important to wait for the confirmation of the pattern before taking any action. Dark cloud cover is a bearish reversal pattern that occurs during an uptrend. This pattern is formed when a bullish candle is followed by a bearish candle that opens above the high of the previous candle, but closes below the midpoint of the first candle. This pattern shows that the bulls were in control initially, but the bears have taken over and are now pushing the price down. The confirmation of this pattern is when the next candle after the second one opens lower than the close of the second candle, indicating further bearish momentum. Traders who identify this pattern can take a short position in anticipation of further price declines. A spinning top is a type of candlestick pattern that is formed when the opening and closing price of an asset are close to each other, with a small real body and long upper and lower wicks. This pattern shows indecision in the market as both buyers and sellers are unable to gain control. Spinning tops can appear in both bullish and bearish trends and are often used as a sign of a potential reversal in the market. The longer the upper and lower wicks are, the stronger the signal. It's important to pay attention to the context of the spinning top and the overall trend of the market before taking any action. The bullish inside bar candlestick pattern is a strong indication of a potential upward trend in the market. It occurs when a smaller bullish candlestick is contained within the high and low range of the previous bearish candlestick. This formation suggests that buyers have gained control over the market and are likely to push prices higher. Traders can use this pattern as a signal to enter a long position, placing a stop-loss order below the low of the inside bar candlestick. This allows for a favorable risk-reward ratio and minimizes potential losses. It is important to note that the bullish inside bar pattern should be confirmed with support and resistance levels. Overall, the bullish inside bar candlestick pattern is a reliable and popular tool for traders seeking to identify potential bullish trends in the market. Multiple long wick candlestick pattern is a trading pattern that indicates a potential reversal in market direction. This pattern is formed by a series of candlesticks with long wicks and small bodies. The wicks represent the price movement of the asset during the trading period, while the body represents the opening and closing prices. A bullish multiple long wick pattern is formed when there are several consecutive candlesticks with long lower wicks, indicating that buyers are stepping in to push prices higher. Conversely, a bearish multiple long wick pattern is formed when there are several consecutive candlesticks with long upper wicks, indicating that sellers are taking control of the market. The evening star is a bearish reversal pattern that consists of three candles. The first candle is a long bullish candle, indicating that buyers were in control. The second candle is a small-bodied candle that opens above the previous day's high and closes below the midpoint of the first candle, showing indecision in the market. The third candle is a long bearish candle that opens below the second candle's low, confirming the reversal. The evening star is a strong indication that the trend is about to reverse, and traders should consider selling their positions or going short. The effectiveness of this pattern can be increased if the third candle closes below the first candle's midpoint. It's important to remember that no pattern is 100% accurate, and traders should always use proper risk management techniques to protect their capital. Separating lines composed of two consecutive candles. It can either be bullish or bearish, depending on the direction of the trend. In a bullish separating lines pattern, the first candle is bearish and the second candle is bullish, with both candles having the same opening price. This pattern indicates a strong shift in market sentiment from bearish to bullish and suggests that buyers have taken control of the market. In a bearish separating lines pattern, the first candle is bullish and the second candle is bearish, with both candles having the same opening price. This pattern indicates a strong shift in market sentiment from bullish to bearish and suggests that sellers have taken control of the market. Concealing baby swallow is a rare candlestick pattern that can occur at the bottom of a downtrend. It is formed by two or more small bullish candlesticks that are completely engulfed by a larger bearish candlestick. This pattern signals a potential reversal in the downtrend and a possible shift in momentum to the upside. Traders should be cautious when identifying this pattern, as it is rare and may not occur frequently. However, if it does occur, it could present a valuable opportunity for traders to enter a long position. It is important to confirm the pattern with other technical indicators and price action before making any trading decisions. 3 Inside Up is a bullish candlestick pattern that forms after a downtrend. It is composed of 3 candles, with the first being a long bearish candle, followed by a small bullish or bearish candle, and finally a long bullish candle that closes above the high of the first bearish candle. The pattern suggests a potential reversal in the market as buyers are taking control from sellers. The small second candle indicates indecision in the market, but the strong bullish third candle confirms the reversal and the beginning of a new uptrend. Don't forget to subscribe and like this video. The 3 Inside Down candlestick pattern is a bearish reversal pattern that usually appears after a strong uptrend. The pattern is formed when the first candle in the pattern is a long bullish candle, followed by a smaller bearish candle that is completely engulfed by the body of the first candle. The third candle in the pattern is another bearish candle that closes lower than the second candle, indicating a strong bearish sentiment in the market. This pattern is a strong indication that the uptrend is losing momentum and buyers are taking control of the market. Traders should take note of this pattern and use it as a signal to exit any long positions or enter short positions.